All right, everybody, welcome. This is Caleb Pearson and Guy Lehman here at Compass Financial. We're both owners and advisors here. And today we're going to talk about retirement plans. And really, we're going to focus in on the three most common retirement plans. I should say company-sponsored retirement plans. The SEP IRA, which is often called a simplified employee pension. And the second one is a simple IRA, which is kind of like a mini 401k. And then there's the granddaddy of them all, what most people are most familiar with, the 401k. Today, we're also going to talk about the difference between a traditional retirement account and a Roth retirement account. And we're also, at the end, we're going to hit on the most common 401k and retirement account questions at the end. So welcome, and let's get started.
Great. Yeah, thanks, Guy. So I'm going to be talking a lot more from the employer side of things. So as we go through each of these different types of plans, I'm going to be talking about the benefits and the things that employers look at when they pick which type of retirement plan to offer their employees. And then Guy is going to make sure to point out things to be thinking about as an employee or as a participant in each of these different types of retirement plans. So to get started thinking high level here, as an employer, there's a lot of different reasons why you offer a retirement plan. One is to retain existing employees and attract new ones. It seems like more and more these days it's common for employers to offer retirement plans. And it could be a reason why somebody maybe chooses not to work with you is because you don't offer a benefit like a retirement plan. Of course, you want to support your employees and their future. Retirement planning is something that people don't always think about, especially early in their career, but it's important to have that as an option to your employees. And then, of course, tax benefits. As an employer, as a business owner, there are quite a few tax benefits about having a retirement plan, not only from the business side of things, but also as a participant yourself in the retirement plan, prolonging and being able to save for your retirement. And we'll talk about some of those things as we go through here.
Yeah, often what I hear from business owners is I want my employees to have something when they're done working here. It's important for them.
Mm-hmm. So as we're looking from the employer side of view at the different retirement plans and what's available out there are multiple things you want to look at. And there's a lot of different options out there. And even within each of the different types of retirement plans we're going to talk about, you can kind of customize it to your liking and make sure it fits your needs, not only as a business owner, but also personally. So we'll talk about with each of these flexibility, tax deductions, how much you can put in, number of employees you have is important. Again, the maximum amount you can put in, whether you want to match or not, and making plan available to all employees, or if you want to use eligibility requirements to limit the type of employee that contribute to the plan. And like I mentioned also before, whether you want to only have traditional savings or if you want to have a Roth option as well is important. So as Guy mentioned again before, we're going to look at the three most popular retirement plan options for business owners: SEP IRA, a simple IRA, and a 401k. And the reason we're doing it in that order is because we're going from the most simple option to the most complex. So we'll start with the basic with the SEP IRA. So with the SEP IRA, this is going to be the most simple to administer. There's not a lot that goes into it. It's not very expensive to administer. There's no annual reporting requirement with the IRS or anything like that. You must include most, if not all, of your employees, even if they're part-time workers. And the reason for that is because as an employer, you're the only one making contributions into a SEP IRA. So as a business owner, if you have money that you want to put aside to all of your employees, but you don't necessarily want them or need them to contribute to the account, the SEP IRA is a great option. Contribution limits, you can put up to 25% of each employee's compensation into the SEP IRA, and the maximum amount in 2023 is $66,000. And again, if you do it for one employee, you have to do it for all employees. So it's really across the board. Whatever percentage you put in for one employee, you have to put the same percentage in for all employees.
Including the owner, because the owner is considered an employee also, right?
Correct.
Yeah.
So Guy, what do employees have to think about when they're looking at SEP IRAs?
Yeah, so a couple of big broad things that apply to all of these retirement accounts is number one, you're always going to get to choose your own investment. So when the contributions are made, what investment are you going to own in that account? Often there's a list to choose from, and often it's a limited list, right? 20 to 30 different types of investments. Usually with one fund company and a 401k, you get some options. But self-directed investments means that you get to choose what you own, right? Stocks, bonds, or some mix thereof. The other thing that's consistent across all these is your contributions that you put in. You know, this one doesn't have employee contributions, but your contributions that you put into these retirement accounts are always 100% vested in yours. You get to keep those wherever you go. So in a SEP IRA, right, the company is putting in money on your behalf. You get to decide what it's invested in. You cannot actually add any of your own money to this account. But what the company puts in is 100% yours, 100% vested right away.
Can you explain what vested means, Guy?
Yeah, so a vesting schedule is defining the company's money when it becomes yours as a participant. So some vesting schedules say, hey, over 5 years, each year you get 20% vested in the amount that we put in for you, either in the form of a match or in the form of a contribution with the SEP IRA. So at the end of 5 years, all of the company's money is yours and you can take it with you or use it someday.
So in this case, with the SEP IRA, it's 100% vested from day one, meaning as soon as the employer puts the money in, it's yours. So if you were to no longer work there, you could take that money and move it over to another IRA or do whatever you want with it. Versus if it was on a 5-year vesting schedule, not all of that money would be yours if you hadn't met that time requirement yet.
Yeah, good question. The last thing here is traditional or pre-tax investing, which is traditionally what a SEP IRA is. A new rule last year came out with a SEP Roth IRA, which is still a company-sponsored plan, but we're going to get into traditional and pre-tax here right in the next slide. So just to explain, when people talk about traditional contributions or plans and Roth contributions or plans, there's a big difference. And the difference is the traditional pre-tax way is the green category that we're looking at. So the money comes into the account before taxes. You hold your investment in that account, and at the bottom, you see when you take it out, it's all taxable at an ordinary tax rate. So let's use a really simple example. Let's say you earn $1 and are choosing the pre-tax 401k, SEP, or simple. You put that in without being taxed on that dollar. And someday that dollar doubles in value and grows to $2. And at the end, when you're 60 and beyond and want to take that money out, you have to pay income tax on both of those dollars. The first dollar because you put it in without paying tax on it. The second dollar is because that was growth and income to you.
And one of the benefits of the pre-tax option is in the year that you contribute it, it reduces your taxable income. So if you make $50,000 a year and you put in $20,000 into the 401k or retirement account pre-tax, that reduces your taxable income that year to $30,000.
That's right. Okay, so that's pre-tax. The Roth portion is on the left, is the red category. And that means you're going to pay taxes on that dollar that you put in up front. So let's say you earn $1, you pay 30 cents of taxes on that dollar. And so 70 cents goes in after tax. And the deal the government gives you there in that category is whatever this grows to, we're going to give you tax-free growth, right? So I've paid money, I paid my taxes on the money that went in, and let's say that 70 cents doubles over the course of time, and now I have $1.40. Well, whenever I take that out at the end, usually after the age of 60, I owe zero taxes on that $1.40. So really the contrast is, do I pay my tax now in the Roth category and have tax freedom later? Or do I avoid paying taxes on it now in the green category and defer my taxes until much later down the road? So this is a difference between traditional and Roth. And later, we're going to get to how do you make that decision about which one to do.
Yeah, and to Guy's point, going back here, up until this year, SEP IRA has always been pre-tax, but because of the CARE Act 2.0, they're creating an option where you can have a SEP Roth IRA. And the next one we'll talk about here is a simple Roth IRA option as well. And the reason we say it's coming is because the law has passed, but there's a lot of extra things that have to happen between with that passing and it actually being available to people to utilize. So we'll see how this year goes, and if that will be available by the end of the year, heading into next year.
Yeah, thanks. Why don't we get into simple IRAs and the employer side of the equation?
Yeah, so a simple IRA is a little bit different, a little bit more complex than a SEP IRA, but still a lot more simple than a 401k. So simple IRA works well for employers who have 100 or fewer employees, so smaller business. If you have no other retirement plan, and it has to be established by October 1st. And what's different between the simple IRA and the SEP IRA is with a simple IRA, you introduce a matching contribution to the equation. With a simple IRA, it's pretty straightforward. You have two options as an employer. You can either do a 3% match to employees, or you can give 2% to all employees. Typically, what we see is that matching contribution because employers like to have employees have a little skin in the game where they're actually contributing to the account as well. Now, employees can put in more than just the 3%. You can see the maximum contribution amounts there. As an employee, you can put in $15,500, or if you're over the age of 50, that they bump it up to $19,000. It's called a catch-up contribution. And those are 2023 limits. And something to remember is every year, maybe not every year, but most years, there's a bump up in whatever that contribution limit is. So if your goal is to max out contributions as a business owner for yourself, or if your employees are trying to do that, make sure you're looking at that every January or a couple of months before the end of the year to update how much is going to go into the simple IRA.
Yeah, so a couple more items in the simple IRA. The vesting is 100%. So any money that you put in that's yours is always yours right away. Any money that the company puts in as a matching contribution is also yours right away. Okay, so that's pretty neat. And another kind of thing going on with both the SEPs and the simple IRAs is it is a company sponsored plan, but the account is opened up in your individual name, which is a little bit different than a 401k, and we'll get into that. So from an employee consideration, again, you're choosing your own investments, often from a list. Typically, you need to add money to this retirement account to get a matching contribution. There's a little less flexibility in the first 2 years, I should say, about moving it around. You can see the employee maximum contributions based on ages and the year. And that does not include what the company is putting in. The company puts in on top of those limits. Now, in all of these plans, there's a special age called 59 and a half. And that is where you can begin to remove money from all of these retirement accounts with no penalty, early withdrawal penalty. If you do want to take money out, there's various rules that apply to each, but typically you're going to have to pay an income tax on it, and you're going to have to pay an additional 10% penalty. So getting money out of these retirement accounts before the age of 59 and a half gets pretty onerous. Now, again, on this one, a Roth option is coming. Up to this point, it's only been pre-tax.
One thing I would go back one slide that I want to make sure to point out is there's a little bit more administration with this than a SEP IRA. These form numbers 5304 and 5305 are IRS forms that you basically use to create the plan, and or if you're making updates to the plan each year. You don't have to file it with the IRS. You just have to have it on file, and you need to provide it to all employees every year so they know the plan is available to them. And the other thing on that, you see there's two different form numbers, 5304 and 5305. The difference between those is, as an employer, you can decide, do I want this simple IRA to be held at one financial institution? Or do you want to allow employees to open up their own simple IRA wherever they want? So maybe they have a financial advisor that they work with and they want to open up the simple IRA with that financial advisor. They can do that if you fill out the proper form. Typically, what we see is people open up, especially if you have quite a few employees, open up the simple IRA in one financial institution, because as you're processing payroll, it's a lot easier to write one check to go to one financial institution versus having to spread those contributions across a dozen different places. So one other thing to consider as a business owner there. So Guy, why don't you jump in here and talk a little bit more about making that decision between traditional and Roth contributions?
Yeah, that's right. So, so again, it's a very difficult decision to make because we don't know the future. And mathematically, at least, it doesn't matter whether you're doing traditional or Roth now, if everything stays the same. And what I mean by that is the tax rates you're paying today, you don't ever earn anymore, or the tax rates never change. It all comes out mathematically equal if everything stays the same as it does today. Now, we know that's not true. We know that as we earn more, or as we get further in our careers, we earn more, we pay a higher tax rate. Congress is always fiddling around with taxes, and that seems to change in the dark of the night by a stroke of a pen. But here's kind of a way to look at it. Are you paying a relatively low tax rate right now, or a relatively high tax rate right now? And that's something you need to dig into and find out what your actual tax rate is. For those that are paying a relatively high tax rate right now, it often makes sense to do traditional pre-tax contributions to lower your income right now. And then hopefully later in retirement, you're earning less and therefore paying a lower rate. And that's the top one. You're paying a high current tax rate, and in the future, you expect that tax rate to be lower. That makes sense to do traditional. And on the bottom, if you're currently paying a lower tax rate and think the future tax rate, you're going to earn a lot more later in life, or you're going to retire into a higher tax situation than you are right now, it often makes sense to pay the tax now and have tax freedom later. So this is just a little graphic, not necessarily, we talked about what the difference is between traditional and Roth. Now here is a little bit about actually how you make the decision.
And another high level planning thought, as financial advisors, we think about this, but when you do get to retirement, it's usually a good idea to have money in different taxable buckets. So you have pre-tax money, you maybe have Roth money, you have non-retirement money. And what that allows you to do is it allows you to pull money from each of the buckets or some from different buckets to really lower your tax rate once you get to retirement. So you're paying lower taxes in retirement. So you may not know what tax rates are going to do, but it may be a good idea to think about having at least some money in the Roth bucket so that you can use that as a tax planning tool once you get to retirement.
All right, we're going to head into 401ks now, and we're going to touch on a lot of things, of course, both from the employer side and the employee side. But I'm just going to start by saying that not all 401ks are created equal. When a company starts a 401k, it's kind of like going down the aisle in a grocery store. They have a lot of different options, and each company gets to make decisions about whether they want to include these options or leave them out of their 401k. And just as an example, there's many, many options, but as a brief example is, hey, when can employees start to contribute? You can restrict that to a year or even beyond, or you can have people be able to contribute right away. Do I want to match? And if so, how much? Do I want a 3% match? Do I want to match dollar for dollar? All sorts of things. Again, vesting schedule. We've always already talked about vesting. The expenses of the plan and who's going to pay those. Are the participants going to pay it, or is the company going to pay it? Loans, yes or no? Early retirement provisions, yes or no? Even the Roth idea. They have an option about whether to put a Roth in their 401k or not. So again, every company is different, but there's a lot of different options available to 401ks.
So as a business owner, I mean, Guy, you touched on quite a few of the points that are on this slide here, but you have a lot more responsibility as a business owner when it comes to 401ks. You, as the plan sponsor, are actually a fiduciary, meaning you need to do everything in your best power to do whatever you think is best in the interest of your participants or your employees. And so as Guy is talking about the matching contributions and the fees and the options that are available, also the investment options that are available within the 401k, you have to have, your finger on that and know what investment options are available and if they're the best for what's in there. You have to utilize a third-party administrator. There are record keeper fees. There's just a lot more going on in a 401k, and there's a much bigger requirement of time and effort and cost as a business owner to be able to utilize a 401k. With that being said, there's a lot of benefits to the 401k. If you're a larger company, more employees, if you're over that 100 limit that a simple IRA has, it's going to be a bit easier in a 401k to have participants and all of that. You can add what's called a profit sharing option, where if you're really wanting to put away a ton of money into the 401k and utilize that for tax benefits, that's an option. As a business owner, if you're wanting to really maximize your contributions into the plan, there's ways to structure it. For your personal account, there's ways to structure it so that you can put in more for yourself than maybe what some of the employees are getting. So there's all kinds of things, and we don't want to get into the weeds and the specifics because every business is different and your goals as a business owner are different. But there are ways that we can sit down and look at constructing a 401k plan and see how it might benefit you and your employees down the road.
And so we've talked about 3 plans here. There's actually a multitude of options out there that go beyond these 3 plans. But our experience has been when you really talk to business owners, even small business owners or large business owners about what they want, it narrows down pretty quickly. And then you can make decisions from there quite easily.
And none of these decisions are permanent either. You can work a 401k plan for a few years and you maybe realize nobody's maxing out the contributions. It's getting too costly. I don't like how it's structured. Maybe we look at simplifying things, moving to a simple IRA, or maybe vice versa. Maybe you've grown and you need to offer something a little bit more robust and go from a simple to a 401k. Now there's rules that you need to follow to make sure you're not contributing to both in the same plan year and those types of things, but nothing is permanent. You can make changes as needed.
So I would say, for an analogy, the SEP IRA is like a pickup game of baseball in the backyard. A simple IRA is like getting all the neighborhood kids together and playing at the local church lot. A 401k is like the major leagues.
Yep. Gets more serious the more complex it gets, and there's a lot more involved in making sure you're doing it the right way. So, Guy, a couple of things on the 401k plan for employees.
Yeah, so again, and we're going to talk about this at the end, a target date fund. But again, you will make the decisions on where your contributions go to be invested in here. And there's often a list that you choose from. The employee contribution limits are much higher. They're in 2023, it's 22,500. And if you're over 50, it jumps up to 30. So you can really sock a lot away if you have access to a 401k plan. Again, Roth and traditional options. Often, the bigger the company you're in, the more likely you have a Roth option, because most 401k plans started off as traditional 401k plans. Loan options, some have them, some don't. And getting money out, again, totally different set of provisions about whether you can get money out or not.
Yeah, to your point earlier with the simple and the SEP, the account at the 401k, it's under the 401k umbrella and it's not your individual account. And so it's much harder to get money out of the account while you're still employed there, especially. So Guy, let's talk about target date funds, because that is a very popular investment option within 401ks.
It is, and often you see target date funds anywhere from the year 2020, often in 5-year increments, all the way up to the year 2065 is about as high as I've seen right now. And what you're supposed to do is you're supposed to pick the year that coincides with your age 65. So if you have a 20-year-old today and they're going to work for 45 years, you're going to pick a 2065 target date fund. And so I want to show you, this is a picture that's called a glide path. And this is for target date funds. So if you look at the bottom, you pick the years before retirement. And let's stick with that 20-year-old. So they have 45 years before they retire. So what you see is the asset allocation, or what they own in their mutual fund, is a lot of growth funds, a lot of growth and income funds, which are primarily stocks, balance funds, which gets into stocks and bonds. And then the green is fixed income or bonds, which are traditionally more conservative. So when they have a long time yet to work, they're very, very aggressive. And you see those percentages come down slowly over time until you hit the retirement date. So the 2065 fund starts very conservative, and every 5 years has a little bit of a allocation balance to what it owns until it gets down to retirement. And you can see about 50-50 mix at retirement. And then it goes on the years after retirement. So they did this to have a one-stop shop for someone who doesn't fully understand what it all means. And we get a lot of that. Hey, I don't understand it. It doesn't make sense to me. And this is a good one-stop shop that will move and change with you as you age through your working career.
Couple of maybe cons to the target date fund side of things is a lot of times they're more expensive. Now expenses have come down quite a bit on these because they're becoming more popular, and so they're being utilized more. And you don't really get to pick which areas of the stock market or the bond market you want to be in. It's up to the fund manager to do that. So in years where maybe international stocks aren't doing very well, they're likely going to hold 10-15% of the account value in international stocks. So diversification works over a long period of time, but there may be some years where a fund like this underperforms some other investment options that are out there.
Sure. The last thing we're going to look at before we get into the most common 401k questions is the power of starting early. And this graph very simply shows if you would start at the age at the bottom, how much you need in monthly savings to achieve a $1 million balance at retirement. Again, this assumes a 6.5% annualized return and does not account for fees or taxes. But you can see if you're a 20-year-old and you want to hit the $1 million mark by the time you're, well, retirement at 65, is you would need to save $310 a month throughout your working lifetime. And you can see how that changes for someone who's 40. All of a sudden now, if you're 40 and you haven't saved anything, you need to save $1,335 a month. And if you're 50 and haven't saved anything, you really need to get after it. Mm-hmm. So just this shows that the most powerful force that you have is time. So get started. Mm-hmm. Let's jump into some of the most common 401k questions. Caleb, what happens to my 401k if I leave a job?
Nothing. most likely. There are some rules within 401ks where there's a force out. Usually if your account balance is under, say, $5,000, it'll either automatically be rolled from the 401k into an IRA, or if it's under $1,000, or they can kind of limit what that amount is, they might just send you a check instead. But typically, once you're done working at the 401k, you still have an account there with the company, you still have an account there. It's still within the 401k, but nothing really happens to it until you make a decision on what you want to do with that. And it's always interesting. We run into clients a lot of times who come in and they say, "Hey, I worked at this company 20 years ago. I never did anything with a 401k. Can you help us track it down?" And a lot of times 401k plans move from sponsor to sponsor, but eventually you track it down and it's not going to go away. You just have to find it. But typically what people do is they either roll it into their new company 401k plan, or they maybe roll it into an IRA, or just take it out completely. But as far as what happens as soon as you're done working there, nothing.
So it's still yours.
Yep.
It's still in the 401k. It's going to do whatever the investment holds that they own in the 401k, and it'll stay there for as long as they leave it.
And you'll still get statements. You'll still be able to access it, all of that. It's just you're no longer working there.
All right. So I heard you touch on this, but the other common question is, what can I do with an old 401k?
Yeah, what can you do? There's really three main options. I kind of mentioned a couple already. You can roll it over if your new company has a 401k or some other type of retirement account that allows rollovers. You could just roll it over to your new employer. You could roll it over to an IRA, or if you have a Roth chunk within the 401k, you want to roll that over to a Roth IRA, keep the taxes the same. Or quite frankly, you could just withdraw the money. Now, we kind of talked about that age 59 and a half number. If you take money out as a withdrawal before that age, you'll pay a 10% federal tax penalty, but also any amount that you take out as a withdrawal is going to be taxed as ordinary income. So typically we like to avoid that, especially larger dollar amounts, because the tax bill is pretty big and it takes away the tax shelter that you have. If you spent 20 years putting away money pre-tax and then you take it all out at once, you're paying a bunch of tax in 1 year, and that's not always ideal. So those are the main options with what you can do when you're no longer working.
Yeah. The last question is, how do you get money from a 401k in an emergency?
So a few options. If you're still working, if your 401k plan allows loans, that's an option. And basically how a loan works is you're taking a loan against your account balance, and there's rules that go into it. And like, you can only take up to 50% of your account balance. And then there's limits as to a certain dollar amount that you can take out. If you take a loan, then you're paying yourself back. Basically, you don't pay taxes on the loan amount that you took out, but you're paying yourself back with a pretty substantial interest rate usually. And as long as you pay that back all the way, you don't pay any taxes on it. Now, if you're no longer employed there, as soon as you're no longer employed, if there's still a loan balance, you may end up having to pay taxes on the full loan amount that you took out if it didn't get paid back in time. So we typically try to avoid the loan option in a 401k, but some people like to utilize it. Especially self-employed people who they're not going to lose their job because they work alone. If they have an individual K, they could take a loan against their balance, and as long as they get it paid off in a reasonable amount of time. So that's one option. The other, if you're still working, I think was mentioned before, is that you can take what's called a hardship withdrawal. There's a laundry list of reasons. If it could be a medical reason, if there's stipulations in there for first-time home buyers, there's an amount you can take out. Those are types of things that you could potentially do, but again, each 401k plan is different. So if you need money and the 401k is your only option, I would encourage you to reach out to your employer and see what options are available to you. Now, if you're no longer working and you still have your 401k, the options I mentioned before about rolling over or withdrawing directly from the 401k apply.
So one of the things that we've seen over the years are 401ks and retirement plans are wonderful accumulation tools. One of the things that we've seen them struggle with a little bit is when someone hits the distribution stage, or the stage that they start taking money out of the account, the investment lineup isn't necessarily geared towards that.
Mhm.
So often we see people want to escape the 401k structure to go have more flexibility in an IRA for the distribution phase.
Mhm.
Another thing about the 401k is that there should be, most places have an advisor, a financial advisor attached to the 401k plan. Because that advisor is giving advice to the plan sponsor or the company that's making decisions about how to navigate it, what decisions to make, how to be a good fiduciary, things like that.
Mhm.
So at Compass Financial, we love to answer these questions. We can give advice on most retirement accounts. And so we would welcome your questions if you want to reach out to us. Our contact information is here on the last page, but we want to thank you for joining us for just a quick overview of the retirement landscape, how it looks, how it works, and even what's changing a little bit.
Thank you.
Have a great day.